Hey, it's Realtor Jess here to talk about the debt to income ratios that lenders use to determine how much home you can afford. We're going to talk about what debts we're comparing to income, what percentages get applied, and how this translates into how much home you can shop for. Your debt to income ratio is simply your debts divided by your income. But what debts and what income? So here we're talking about your monthly debt payments. So that's your student loans, your car loans, your credit card, any other debts that are going to appear on your credit report, like medical debt. And so the monthly amount of that. So we don't want your balance, just are you paying $500 a month on your student loans or $400 a month on your car loan, not your car insurance, but on the loan itself. And your income is your gross monthly income. So that's before Uncle Sam gets its cut of taxes. That's before they take out your health insurance. That's your gross monthly income. Let's do an example. So if you have, let's say, $500 a month in student loans, and then $400 a month in car loan, and then you're paying $300 a month on your credit card, this adds up to $1,200 of monthly debt. Then if you make, let's say, $84,000, and you divide that, $84,000 a year is your annual salary, then you divide that by 12 months, your monthly salary, your gross monthly salary is $7,000 a month. So if you were to take the $1,200 of monthly debt obligations, monthly debt payments down here, and then you divide that over the $7,000 you make per month, your debt to income ratio is 17.14%. Stay tuned for why that number matters. Why does your debt to income ratio number even matter? Well, the mortgage programs that I discussed in my previous video all come with debt to income ratio limits. So the mortgage programs want to make sure that you're not taking on more debt than you can handle, and they ensure that by limiting how much debt you can take on. So they'll say the current debts you already have that you're paying on your monthly obligations for your student loans, your credit card, your car loan, those plus the new housing debt that you're taking on cannot be over a certain amount. Well, what amount is that? What percentage is that? Well, general rule of thumb is to say 43%, right? If you're doing it at home, I always think about when I'm doing it for clients, on the back of a napkin, I always do it as 43%. But some programs allow you to go above that. So the Fannie Mae Home Ready program, the 3% down program that I mentioned in my last video, allows you to go up to 50% of your debt to income, right? And the FHA program, the 3.5% down with the lower credit score requirement, the 580 instead of the 620 here, allows you to go up to 55% of your debt to income ratio. So please note, some lenders might have their own personal limitations on how much they let you go up, but these are sort of the general ratios that matter. Let's do an example. So back to before, where you were making $7,000 of gross monthly income, we multiply that by our 43% ratio, so 0.43, right, because it's a percentage. And that gives us $3,010 of debt that we could take on per month. You're already using $1,200 of that for your credit card, your student loan, and your car loan. So that leaves $1,810 for your housing payment. For a lot of people, knowing how much monthly housing payment they can afford is sufficient. You look at the online calculator and you can see, hey, X property would be about this per month, and that's more or less than what it seems like I can afford. But if you're interested in really taking it to the end, I'm happy to show you how. So going back to our example where you have the $1,810 left over for your housing payment, you then want to subtract for a few things: your mortgage interest, your property taxes, your homeowner's insurance, and your association fees. So if you're in a condo or in a homeowner's association, your HOA fee. So here I'm going to estimate that to be about $410 for our fictional buyer. And subtracting those amounts leaves you with $1,410. That's $1,410 you have left for the actual mortgage payment. That's the principal and interest. And then I use an amortization calculator, which you can find online. And I put in a 3.5% interest rate for 30 years or 360 months, same thing. And that gives me an amount of about $310,000. So I kind of just play with numbers. And here, this person, if they were looking for a home, we would want to keep them around $310,000 so that their payment would be around $1,410 and adding all of the incidentals. So that's how you translate how much you can spend per month into the amount that you're going to shop for or look online for on my website, jessicaortizrealty.com. All right, time to recap. So to determine your home affordability, you'll want to first compare your debts to your income. Then you want to apply the ratio for your desired mortgage program. And then lastly, if you're up for it, you want to translate your housing payment into your home shopping budget. So remember, your home shopping budget depends on the amount of house payment you can afford each month, which is determined by your interest rate and your DTI calculation. So remember to keep your credit score up so you get the lowest interest rate and your debt payments down so you have room in your DTI calculation. Thanks for watching to the end. You are truly helping this queen achieve her dream.